A single $1 billion order has been finalized. Commercial revenue is surging 137%, and Palantir is rapidly becoming one of the most irreplaceable operating systems of the AI era. But with a trailing price-to-earnings ratio approaching 260 and a PEG ratio near 3.0, is this the ultimate wealth opportunity for the brave or one of the most expensive growth illusions in financial history? Hey everyone, welcome to Stock Market Breakdown. Recently, Palantir Technologies PLTR has been on a huge run. This isn't just Hyperial AI demand is driving it, with billion-dollar deals and a 57% margin. Palantir's cash power is clear, but valuation already prices in years of growth. What happens next? Palantir recently signed a 5-year procurement agreement worth up to $1 billion. This is not just a large contract. It represents a crucial operational turning point. The agreement significantly simplifies how different branches within large organizations purchase software internally. Breaking down this kind of procurement barrier signals that Palantir's AI platform is moving from isolated pilot deployments into a full-scale expansion across complex institutional systems. You have to read the hidden message behind a on-bid deal. In large organizations, the hardest part isn't writing code, it's navigating the procurement maze. Once a company secures a system-wide contract, it effectively becomes a standard data platform for Palantir. That means not just revenue today, but years of deep customer lock-in. The latest financial data once again confirms Palantir's steep growth trajectory. Fourth quarter revenue jumped 70% year-over-year to $1.04 billion. While performance in its core markets was even more explosive, showing 93% growth in a single month. Even more impressive, its commercial segment revenue surged 137%, while total customer count grew 34% year-over-year. This phenomenon, where revenue growth far exceeds customer growth, indicates that existing clients are dramatically expanding their spending, demonstrating powerful demand expansion and extremely strong product stickiness. We need to focus on the 137% commercial revenue growth. It shows that Palantir has firmly proven its dominance in the market, is becoming a key partner for top global companies navigating the AI transformation. A growing customer base, combined with deeper value per client, forms the twin engines driving Palantir's expansion. Under standard accounting rules, Palantir generated $575 million in operating profit, with an adjusted operating margin of 57%, placing it among the elite performers in the software industry. Even more importantly, the company's cash generation capability is extremely strong. In a single quarter, it produced approximately $790 million in free cash flow. Its balance sheet currently holds about $7.02 billion in cash. With an exceptionally clean financial structure, this healthy balance sheet provides enormous flexibility for future R&D investment or strategic expansion. A 57% margin shows Palantir isn't doing low-value grunt work, it's running a high-margin, high-barrier business. Even more powerful is its $7 to be as cash reserve. In today's rate environment, that's not just safety, it's firepower, allowing Palantir to invest in R&D or acquisitions while competitors struggle for capital. However, beneath the strong performance lies a clear valuation risk. Palantir's trailing divided by E ratio currently stands around 259, while its forward divided by E remains as high as 145. This means investors are paying a price that already assumes extremely rapid growth for years into the future. By comparison, most blue-chip software companies typically trade between 20 and 40 times earnings. Such an elevated multiple leaves very little room for error. Even small shifts in sentiment could trigger sharp price volatility. A 259x divided by E is a real heart-pounding game. It means the market expects Palantir to deliver near-perfect growth for years. Even one earnings report that only meets expectations that beats them could trigger a sharp correction. At this level, investors aren't buying the present, they're buying the myth of long-term dominance. If we examine the PEG ratio, which compares the price-to-earnings ratio to earnings growth, Palantir's current figure is close to 3. In traditional value investing logic, anything above 2 is generally considered expensive. A PEG ratio of 3 reveals a harsh reality. Even under the most optimistic growth assumptions, the current stock price is already running well ahead of the company's earnings trajectory. This disconnect between valuation and performance is one of the stock's most significant structural pressures today. What does a PEG ratio near 3 really mean? It means the company's profit growth would need to double again just to justify the current valuation. That's what I call forced growth. If future growth slows even slightly due to market conditions or technological shifts, valuation mean reversion could hit the stock like gravity. Another side of the risk is volatility. Palantir's 60-month beta stands at 1.7, meaning its volatility is roughly 70% higher than the broader market index. In an environment where AI stocks are already experiencing intensified fluctuations, this high beta characteristic becomes a double-edged sword. When macro pressures rise or institutional investors start locking in profits, Palantir's declines can often be significantly deeper than the average stock. This level of volatility demands strong psychological discipline and careful position management from investors. A 1.7 beta means Palantir acts as a market amplifier. You ride the highs in style, but when the market pulls back, the drop can be shocking. Without a solid strategy, simply holding long risks being forced out during irrational swings. Given the current elevated valuation, blindly chasing the stock higher carries substantial risk. Instead of jumping in at peak sentiment, investors might consider strategies like cash-secure put options. This approach allows investors to collect option premium while waiting for a more attractive entry price. If the stock pulls back, you acquire shares at a predetermined cost basis. If the stock continues rising, you still retain the premium income, creating a more balanced capital deployment strategy. This is what I call trading time for space. With such a hype divided by E, buying outright leaves almost no margin for error. Using options, you turn market swings into discounted entry points, while collecting premium a far more rational approach than buying at the peak. Over the long term, Palantir still possesses a powerful structural story. As global productivity systems continue to evolve, demand for AI capable of handling complex tasks is rapidly accelerating. Palantir's deep integration within large institutional systems creates extremely high industry barriers and technological irreplaceability. This is more than software. It's infrastructure for future data-driven decision-making. The long-term defensive positioning represents its ultimate moat against market cycles. In short, Palantir is expensive for a reason, yet risky. With billion-dollar contracts and strong financial firepower, it faces a heavy valuation. Can its uniqueness justify the premium? Play at the top or wait strategically. Comment, like, and subscribe to Stock Market Breakdown.